welcome back. We're talking now about your money. Stocks plunged Monday morning before ending the day down big. The Dow plunged more than 1,000 points. The NASDAQ lost 576. The S&P 500 gave back 160. What will today bring? A lot of questions remain. Does the volatility give us any clue about what to expect today or in the coming months? Joe Fitter is the director of the MBA Strategic Finance Academy at IU's Kelley School of Business. Joins us live now to answer some questions. Joe, good to see you.
Hi, good to see you as well. Good morning, everyone.
Hey, yeah, let's just talk first, give your insight onto kind of what you're seeing so far this morning overseas, what you thought about yesterday, and your overall picture here.
Yeah, so yesterday was one of those kick in the gut kind of days, but it was preceded by a few days of really shaky market action. The unemployment report came out last week. People were a little bit nervous because the unemployment numbers were a little bit higher than normal, and that sort of started a cycle. But then the real catalyst for the latest drop was what was happening over in Japan. And you say, well, how in the world does Japan affect the U.S. financial markets? Well, financial markets are interconnected, and the value of the Japanese yen spiked pretty significantly. And that caused a certain kind of a trade, basically a speculative trade, to start to unwind. And when you have a trade that's unwinding quickly, it causes markets around the world to get sold off. And that's what we saw in the U.S. stock market. That's what we saw in Europe. We saw a lot of what we call risk assets, things like stocks and maybe cryptocurrency, all falling, being sold off in order to cover these speculative bets.
Yeah, let's talk about what you're expecting to see today or, in the next coming weeks.
The good news is overnight, Tokyo stabilized. It had fallen 20% over the last couple days, and it rebounded 10.5% overnight. So it's made up about half of what it lost in the previous few sessions. And so that's good news. That says there's stabilization. There were some programmed trades that were kicking off that finally have subsided. Now, we're not out of the woods yet. Normally, when these kind of crises happen, it takes several weeks for the decks to clear. We still don't know what maybe has blown up in the background, what banks might be in trouble, but we have an idea, at least over the last 12 hours, that things are relatively stable. The yen is not appreciating any further. It's stabilized at about the 145 level, and even the U.S. stock market in pre-trading this morning looks like it's up just a little bit.
Yeah, we just showed a picture of that, the futures. We had that up kind of showing where we are right now. So that is, something to look, at least a little bit forward to. I want to talk to you about something that a lot of people are talking about is when the Fed's going to make this interest rate cut. They were talking about it last week and thinking that they were going to, and now saying that there needs to be an emergency Fed rate cut. Other people are saying, chill out. No, that's not what needs to happen. I definitely don't know. What is your take?
Yeah, my commentary is chill out. These kinds of market hiccups happen about once every 18 to 19 months. It's been about 28 months since we saw a 10% drawdown in the U.S. stock market. So we're quite honestly overdue for a correction. Some of the tech stocks and AI-oriented stocks were really getting frothy. And so these kind of corrections are normal. And the Fed generally won't jump in this kind of a situation where there's an isolated drawdown. Really, what's happening right now is everyone is watching inflation and watching the consumer. Inflation has come down. It's down to about 2.5% per year. But we really need to get to that Fed target of 2% before the Fed really will feel confident that they can lower interest rates without restoking the fire of inflation. And for those viewers who are old enough to remember the 1970s, that's exactly what happened in the 70s. We got inflation under control, and then the Fed dropped rates, and it reignited inflation, and it made for a really tough decade. The other aspect really to keep in mind here as the Fed thinks about reducing interest rates is how is the consumer doing? And we've gotten some anecdotal reports, things like McDonald's and Starbucks earnings came out. It was kind of soft, which means the average person that goes to McDonald's can't afford the price of a Big Mac these days. Or
right.
Someone who's going to Starbucks and ordering a latte can't afford the price of the latte because of inflation. And so we're seeing the consumer get stretched.
Okay.
But the economy is not in that state of condition where companies are closing and the unemployment rate is spiking above 5%, it would really be that level that would start raising a lot of concerns, a lot of alarm bells.
All right,
It's
so
still
I got to
early
jump in
and it's
here.
uncomfortable.
Yeah, I apologize, but my producer about a minute ago said, hey, we got to get to weather right now. I appreciate you. Sorry that we didn't have longer to talk, but a lot of great information. You obviously know what you're talking about. We'll have you on again, but it was good to see you. And again, something to think about as we watch. And Jim, I know we've been taught, at this time, just don't even look at the 401k right now.
Yeah, stay calm.
Right?
Stay calm and carry on.